Stop what you're doing right now because oil prices are moving in ways that could ripple through your wallet, your portfolio, and even the global economy. Ukrainian drones just slammed into Russia's critical energy infrastructure, setting off massive fires, disrupting supply, and making traders from London to Wall Street sit up in their chairs. And just when you think that's enough chaos, the Federal Reserve is hinting at rate cuts, which could supercharge demand expectations. This is one of those moments where geopolitics, economics, and finance collide in real time. And I'm going to break it all down for you so that you not only understand what's happening, but also know what it could mean for the days, weeks, and months ahead. So let's start with the facts. Ukrainian drone campaign hit the Ust-Luga fuel export terminal, one of Russia's most vital gateways for refined petroleum products. This isn't a minor depot. It's a hub that ships jet fuel, naphtha, and other refined products to international buyers. The attack sparked an inferno that forced operations to a crawl. Almost at the same time, Ukraine struck the Novoshakhtinsk refinery in Russia's Rostov region, which processes about 100,000 barrels of oil every single day. Let me repeat that. 100,000 barrels daily. That's not just a hiccup. That's a major artery in Russia's refining system being blocked. Now, oil isn't like other commodities. It's not like grain where you can just reroute from one silo to another. Refineries are precision-built, capital-intensive machines. If a drone damages the wrong part of the facility, it can take weeks, even months to bring it back online. And Russia, under heavy sanctions, doesn't exactly have easy access to Western technology or spare parts. So these strikes hit not just today's supply, but potentially tomorrow's and the week after that. And it wasn't only oil. Ukraine even managed to disable part of the Kursk nuclear power plant, forcing half its reactors offline. That one didn't cause a radiation leak, but it sent shockwaves through energy security discussions in Europe. Imagine being in Brussels, watching Ukraine successfully target both oil and nuclear infrastructure inside Russia. You'd suddenly realize the war has entered a whole new phase. Now, how much of a dent are we talking about? Analysts estimate as much as 17% of Russia's refining capacity went offline because of these attacks. That translates to about 1.1 million barrels per day of processing power gone in a flash. To give you perspective, that's more than the entire daily oil consumption of Spain. Overnight, it disappeared. Russia scrambled to patch the hole. Officials rerouted exports from western ports like Primorsk and Novorossiysk, boosting flows there by about 200,000 barrels per day. That's basically triage, an emergency response to keep revenues flowing and prevent total collapse in shipments. But it doesn't fully replace what was lost. It's like patching a tire with duct tape. You can keep driving for a bit, but it's not sustainable long term. And the markets, they reacted instantly. Brent Crude, the global benchmark, jumped by over $1, trading near $69 a barrel. West Texas Intermediate, the U.S. benchmark, leapt almost 2% to hover around $65. Think about that. Billions of dollars shifted in a matter of hours, triggered by a few drones costing a fraction of what the infrastructure they destroyed is worth. That's the asymmetry of modern warfare hitting the financial world. But it gets juicier. At almost the same time this was happening, the Federal Reserve was signaling that it might be ready to cut rates soon. Lower rates weaken the dollar. And when the dollar weakens, commodities priced in dollars, like oil, become cheaper for international buyers. That tends to stoke demand. So what we had was this rare double catalyst. On the supply side, disruption and fear. On the demand side, monetary easing and optimism. Traders heard the word bullish echoing across the market floor. Of course, nothing is ever that simple. Just as supply fears and Fed hopes were pushing oil up, another piece of news landed on the desk. The U.S. imposed new tariffs on Indian imports, punishing India for buying discounted Russian oil, refining it, and then selling products globally. India has been one of the fastest growing oil demand centers in the world, so the tariffs raised fresh concerns about trade, growth, and demand. And just like that, the rally met resistance. Prices steadied, even pulled back slightly as traders digested the possibility of slower demand growth. This push and pull is classic oil market behavior. It's never just supply or demand, it's always both. both colliding in unpredictable ways. And if you've been following oil for years, you'll know this is déjà vu. We've seen supply shocks from wars before: the Arab-Israel conflict in 1973, the Iran-Iraq war in the 1880s, the invasion of Kuwait in 1990, the U.S. invasion of Iraq in 2003. Every time oil prices spiked as supply came under threat. The difference today is that it's drones, not tanks. It's asymmetrical warfare with relatively cheap weapons causing disproportionately massive damage. That changes the calculus for traders and policymakers alike. Let's pause and think bigger. Why does all this matter beyond just a few dollars on the price of crude? Because oil touches everything. It's the gasoline in your car, the diesel in the trucks that deliver your groceries, the jet fuel in the planes that take you on holiday, the raw material in plastics, fertilizers, and chemicals. When oil rises, costs ripple through the entire economy. Inflation gets stickier, central banks get nervous, corporate margins tighten, stock markets wobble. And for emerging markets, higher oil bills can wreck balance sheets and currencies almost overnight. That's why you'll hear people say oil is the master commodity. It sets the tone for everything else. And right now, that master commodity is being pulled in two directions: up by war and sideways by policy. Let me put myself in the shoes of a trader for a second. You're sitting at your desk, you see the headlines. Ukraine takes out a refinery. Russia reroutes exports. Fed hints at cuts. US slaps tariffs on India. What do? Do you go long oil, betting prices will spike further if Ukraine keeps striking? Do you hedge your positions, buying options in case volatility surges? Or do you fade the rally, thinking Russia will repair facilities faster than expected and demand will cool? These are not academic questions. They're billion-dollar decisions being made right now in trading floors across the globe. And let's not forget the political angle. Ukraine's strategy is crystal clear: squeeze Russia's economy by targeting energy infrastructure. Russia's oil and gas revenues fund the war, pay for imports, and keep the domestic economy afloat. By forcing refineries offline, Ukraine triggers domestic fuel shortages, skyrocketing gasoline prices at home, and export revenue loss abroad. Already, reports suggest Russia's domestic gasoline prices have risen by over 40% since these attacks began. That hits ordinary Russians directly and tests Moscow's ability to keep the home front stable. It's warfare by economic attrition. And so far, Ukraine is showing it can pull it off. But Russia won't just sit back. They're already rerouting exports and may push OPEC Plus to adjust output to stabilize prices. That's why the upcoming OPEC Plus meeting in early September is critical. If OPEC Plus hints at more supply coming online, that could cap the rally. If they hold firm, prices could keep climbing. That's the knife's edge we're on right now. So where do things go from here? If Ukraine escalates and takes out more infrastructure, oil could surge into the mid-70s for Brent, maybe higher. If the Fed follows through with a September rate cut, demand expectations could rise and amplify that move. But if tariffs escalate into a broader trade war with India, or if China's economy slows further, that could slam the brakes. And in markets like oil, the brakes can hit just as hard as the accelerator. This is why oil is such a fascinating market. It's not just numbers on a screen. It's geopolitics, economics, war, technology, psychology, and strategy all mixed together. It's the battlefield of nations and the playground of traders happening simultaneously. For you, the viewer, what matters is that these moves will eventually hit your life. If crude sustains these levels or climbs higher, you'll feel it at the gas pump within weeks. Airlines will raise ticket prices. Trucking companies will pass costs down the line. Inflationary pressures could resurface just as central banks are trying to declare victory. And if you're an investor, energy stocks and ETFs suddenly look a lot more interesting, while industries like airlines and logistics might feel pressure. So let me leave you with a few things to watch closely. First, Ukraine's drone campaign. Every successful strike adds fuel to the bullish fire. Second, the Federal Reserve. If they cut rates, oil demand expectations will shift overnight. Third, U.S.-India trade tensions. If those escalate, demand forecasts could weaken dramatically. And finally, OPEC Plus. That meeting is coming, and it could decide whether this rally keeps going or gets papped. In short, Ukraine's strikes have thrown the oil market into turmoil, knocking out major refining capacity and jolting global prices. The Fed is adding fuel with rate cut hopes, while tariffs and trade tensions complicate the demand side. Russia is scrambling to adapt, but the world is watching to see how sustainable that patchwork is. And right now, oil is sitting in a volatile sweet spot where every headline can swing billions of dollars. If you found this breakdown useful, smash that like button, subscribe, and turn on notifications. I drop these market updates every week, cutting through the noise to bring you what actually matters for your money. And let me know in the comments, do you think oil will break $75 soon, or do you think demand headwinds will keep it capped? I'll be reading your takes and responding in the next update. The war in Ukraine is evolving. The Fed is shifting gears. The markets are reacting in real time. And oil, once again, is right at the center of it all. Stay sharp, stay informed, and I'll catch you in the next one.